Well, hello, everyone. Thank you for joining our 401k class today. We appreciate you sticking with us all week and trust you've gotten a lot out of the various topics that have been covered so far. My name is Matt Knorr, and I'm the Director of Defined Contribution Plans here at Definiti. So all of your 401k plans, profit sharing plans, 403b, 457 plans, I oversee those plan types here for the company. Again, I appreciate you all sticking with us this week. I know there's been a lot of content. We have some additional great information to go over today. The first topics that we're going to be going over are on long-term part-time employees and also the Secure Act 2.0. And our presenter for our first class today is our in-house ERISA attorney, Brooke Cozort. So I'm going to turn it over to her, and she's going to go over long-time part-time employees and Secure 2.0. Brooke, go ahead. I think you're muted. Brooke.
Yes. Thank you so much, Matt. I don't want to point it out, but he did stutter saying long-term part-time employee, and I hope that I will try and get that, but that's one of the biggest tongue twisters. So I will attempt to make sure that that comes out clearly as I'm presenting today, but that is what I'm presenting on today, long-term part-time employees, and then the up and coming, perhaps, Secure 2.0. I will take questions at the end, so if you could just hold those, then I'll be able to see in the Q&A or in the chat any questions that come up. But if you don't mind just waiting, I might get through those as we go through the presentation, but if not, I will get those questions reviewed and answered at the end if possible. So we have quite a bit of content to cover today, so let's just jump right in. So our agenda today, we're going to discuss the long-term part-time employees, how the Secure Act first version impacted it, how it works in practice, the deadlines for a plan to be amended to include such provisions, what guidance we're waiting on from the IRS in order to fully implement these provisions. And then next, we're going to discuss the Secure Act 2.0. It has not been enacted, but there are some great provisions included in the Secure Act 2.0. And I will discuss how it's going to change the discussion I'm going to have on the first half of long-term part-time employees, because there are some changes included in the Secure Act 2.0 on that provision, the auto-enroll mandate, and then some other important provisions that I think would be helpful for you to know. So just to start, why does Congress care about this long-term part-time employee, and why is it included in the Secure Act? And the reason is because Congress believes that there is, and as I'm sure you've read numerous times and in numerous articles, there is a concern about retirement readiness throughout the United States. And a lot of this stems from employees who are part-time employees, and maybe they weren't part-time prior to the financial crisis of 2008 and 2009, but their job was changed from a full-time job to a part-time job. Congress has recognized that this impacts women disproportionately to men. And then Congress has also seen that when a participant has access to retirement savings through payroll deductions, that employee tends to save more than a person who only has access to, say, an IRA or any other savings vehicle. So the Secure Act was the Secure Act was enacted in 2018, and it included a provision on the long-term part-time employee to address this congressional concern. So what it did, in the traditional rules under the IRS, a participant must be eligible to contribute to a qualified plan if that participant has worked for at least 1,000 hours in a 12-month period and is over age 20 or is 21 or older. So what the Secure Act did is it added this red bullet point provision that also says, if a participant completes 500 hours in 3 consecutive 12-month periods, then that person too must be eligible to contribute to a 401k plan. As you notice here, it did not include the age 21. That was later added down below under 401k 15 that states that the long-term part-time employee rule does not have to apply unless the participant is over age 21. So Although it's not included in the first provision that I had above, it is included lower down below in the code that does state that a participant now, if they don't meet the 1,000 hours in a 12-month period and are age 21, then they can move to the second provision, which would be age 21, and then work 500 hours in 3 consecutive 12-month periods. The effective date for this provision is for plan years beginning after December 31st, 2020. Well, you may say, we're already in 2021, why hasn't this impacted us yet? Well, it's because service credited before January 1st of 2021 is not required to be counted. And as you recall, the provisions state that an employee must work for 500 hours in 3 consecutive 12-month periods. So technically, depending on the terms of your plan, this won't impact your plan until potentially January 1st of 2024. And the entry dates are similar to what's required, or the entry date is the same as any entry date in the code. Once an employee meets those eligibility provisions that I enumerated, so the 12 months or the 3 years with 500 hours in each year, once an employee hits either of those requirements, then he or she must enter the plan no later than the first day of the plan year or 6 months following the date in which that participant met the age and service requirement. So for a calendar year plan, it's typically the plan is going to state that there's semi-annual entry dates. So here, a participant, once they met those requirements, they're going to come in either on January 1st or the following July 1st once they meet those provisions. So that entry date hasn't changed from the traditional rules. Further, what are the limitations of the Secure Act? So the Secure Act does not require that a plan sponsor adopt a 401k plan. Although you've seen there's other state mandates, that's not a part of the long-term part-time employee provision. What it simply states is, if an employer chooses to have a plan that contains a 401k deferral feature, this rule must apply. And I specify 401k feature because, as you'll see below, this rule does not apply to union plans. It doesn't apply to 403b plans because, for those of you familiar with 403b plans, there's already a universal availability requirement that states that with some exceptions, basically an employee on day one must be eligible to contribute to a 403b plan. And then further, it doesn't apply to 457b plans because there's no coverage requirements under those plans. So we'll discuss a little bit about how this long-term part-time employee provision works in practice. So once an employee meets these age and service requirements, enters the plan, such employee must be able to commence participation. All this means is they need to be able to contribute either on a pre-tax or a Roth basis, depending on what the plan allows, as of that date. And as I discussed earlier, due to the exclusion of years prior to January 1st, 2021, a long-term part-time employee may not become eligible until January 1st of 2024. So if a plan sponsor decides, or if a plan sponsor typically funds employer contributions, including safe harbor contributions, these long-term part-time employees are not required to be covered under those contributions by the employer. They can, but they're not required to be. And then further, if a plan is top heavy, then these long-term part-time employees, although they're eligible to contribute, they won't be required to receive a top heavy minimum from the plan. If a plan sponsor chooses to make employer contributions for these long-term part-time employees, they can be disregarded for non-discrimination purposes. So for those of you who may fund an employer contribution based on individual rate groups, you may fund X% for this group and Y% for the other group. These long-term part-time employees, you may decide to fund a minimum benefit for them, but it may not impact the non-discrimination testing. That won't impact the plan. You can disregard them from non-discrimination testing. You can disregard them for coverage testing. So again, you could give them a different contribution percentage than the other employees within your company. You can exclude them from ADP and ACP testing. That's the testing that tests employee contributions and the matching contributions. As I said earlier, you can exclude them from safe harbor contributions and then the top heavy minimum funding contributions. So if a long-term part-time employee changes their status, so they become a long-term part-time employee eligible for the plan because they had experienced 3 12-month periods in which they met 500 hours in each of those periods, If they then convert to a full-time employee, or at least an employee that works at least 1,000 hours in a 12-month period, then that employer is no longer considered a long-term part-time employee for this provision. So what that means in practice is that a plan sponsor can no longer disregard that participant for any employer contributions that are funded to the plan. So in my example earlier, where we've got the contribution based on individual rate groups, now if you give this participant less funding, whatever you decide to give that participant, now that participant is going to be included in the non-discrimination testing purposes, so it could potentially impact your plan. Further, this employee must be eligible to share in any contributions the employer provides. So for example, if you're a safe harbor plan, you now must fund safe harbor contributions to these employees once they change their status from long-term part-time to then just a traditional eligible employee. And then the effective date in which that change of status will occur is the first day of the plan year following the plan year in which that employee meets that 1,000 hour requirement in a 12-month period. For vesting purposes, this is a tricky and sticky topic, so we're going to go into this a little bit further. But just note, if an employee is if these long-term part-time employees are only eligible to contribute, meaning the plan sponsor has decided we're not going to fund an employer contribution to these employees, vesting is irrelevant. It's not important. It may become important down the road if you decide to then contribute employer contributions, but assuming that this employee is only eligible to make employee contributions, vesting is irrelevant. If the long-term part-time employee is eligible for employer contributions and not just safe harbor contributions, vesting is relevant. And so we're going to discuss the vesting next. So we're going to use the same rule, the 500-hour rule. So if a long-term part-time employee receives an employer contribution that's not safe harbor, that long-term part-time employee must receive a year of vesting credit for any year in which he or she works 500 hours in a 12-month period. Typically, what you're going to see in a traditional plan is a 1,000-hour vesting credit period. So if an employee works 1,000 hours in a 12-month period, a traditional employee will get 1 year of service, vesting service. But with these long-term part-time employees, the IRS has brought the hour requirement down to 500. So note, this rule only applies to employees who are eligible to participate solely because of this rule. And I bring this up because some of you may already have this provision in your plan where you have, let's say, immediate entry for deferrals for employees to contribute. But then you may have a year of service for employer contributions, safe harbor contributions. So in that case, this long-term part-time employee rule does not apply. You are just, that person is eligible because you have a more lenient eligibility provision for employee contributions. When that's the case, the 1,000 hours for a year of vesting credit still applies. So if I have eligibility for all sources in my plan, employee contributions, employer contributions, if I have eligibility provisions of 1 year, 1,000 hours, semi-annual entry dates, and age 21, then I have to apply the long-term part-time employee for my long-term part-time employees. If I allow employees to contribute immediately, but then have this year of service for employer contributions, then I don't have to even worry about this long-term part-time employee provision. You may ask yourself, well, then why not just do this? And I'll tell you why. We're going to discuss this a little bit further, but there could be negative implications to this. And that's where Secure Act 2.0 comes in. So we'll discuss that in just a moment. One of the tricky things is in the Secure Act, they stated that for this long-term part-time provision, you can disregard years of service for eligibility purposes prior to 1/1 of 2021. That is not the case for, that is not the case for vesting purposes. There was no language written in the Secure Act that stated you can exclude years of service prior to 1/1 of 2021 for vesting purposes. So as it stands today with the language in the Secure Act, all years of service all years of service for these long-term part-time employees must be considered for vesting purposes. So again, anytime an employee worked 500 hours in a 12-month period, that participant's going to get credit for vesting purposes. Note, there are some plans and there's options in a plan where you can disregard service for vesting purposes prior to the age of 18 or prior to the effective date of the plan, and that's the original effective date. So if that exists, then you could disregard those years, but otherwise, a lot of plans don't disregard those years of service. So in that case, then these long-term part-time employees are going to get credit for every single year in which they work up 500 hours. So this is administratively burdensome. And so because a plan sponsor is going to have to go back through the entire employee's work history to determine this vesting credit. Again, if the employee is only eligible to contribute employee contributions, this vesting is irrelevant. So I spoke a moment ago about what happens when employee changes status from an eligibility standpoint, from receiving employer contributions. If such employee that was previously considered a long-term part-time employee changes status to a traditional eligible employee for the plan, meaning he or she has worked 1,000 hours in a 12-month period, that then changes that person's status to where they are required to receive employer contributions. That status change does not impact vesting. So for a participant that was eligible to receive employer contributions as a long-term part-time employee, that employee receives vesting credit for each year in which he or she works 500 hours. If that person now becomes a full-time employee, that person still gets the benefit of a 500-hour vesting credit. So we don't change now the requirement that that employee is subject to 1,000 hours for vesting purposes. It stays at 500. So that's just administratively burdensome as well. So the IRS is definitely trying to iron out some of these provisions. And as you can see, they released IRS Notice 2020-68, specifically asking for comments. And some of you guys may switch over to the financial advisor track, in which Brian Graff of the American Society of Pension Professionals and Actuaries, ASPA, he's going to be speaking. But people like him from ASPA, they're advocating on behalf of plan sponsors, just stating this is very burdensome. We need to change the way some of this language is written. So there are some changes coming down the pike as far as, and especially I'm about to mention stuff in Secure Act 2.0. But just some of I hope none of you are stressing. We're here to help you whenever these provisions really do impact you. But there's just some requests by people in the industry just stating to the IRS, this provision is burdensome, that provision is burdensome, and this is what we would recommend. So there's definitely people in the industry advocating on your behalf. So from a plan document standpoint, when does this provision have to be in your plan? So a plan must be amended no later than the last day of the first plan year beginning on or after January 1st of 2022. So for a calendar plan, that plan document needs to be adopted, or pardon me, that amendment needs to be adopted no later than December 31st of 2022. We work with ASC as a plan document provider. They have not provided this document yet. I do know some other plan document providers have. I'm about to discuss Secure Act 2.0, which could change some of this. So they have very good reason to hold off on making any of these documents available as of this date. But we will be amending plans starting next year for the Secure Act, including this provision. If you administer or if you sponsor a governmental plan, you have until 2024. Regardless, plan sponsors should always just keep track of how they're handling these plans. If you're going ahead, if you do have these long-term part-time employees and you're tracking their hours from year to year, making sure if they meet that 500 hour, they come in by 1/1 of 2024, you just need to be keeping track of how you're administering your plan. So I mentioned that the IRS provided a notice requesting comments on how they should change. I'm just going to mention a couple of areas in which we are waiting for more IRS guidance because it's unclear on some of the provisions on how the provisions are going to impact your plan specifically. So from an eligibility standpoint, a plan sponsor, if you employ union employees or non-resident aliens, this long-term part-time rule does not apply to those employees. But if you have another provision in your plan, let's say, for example, you exclude, you're a dentist office and you exclude hygienists, or you're a company that has multiple divisions and you exclude division A from being eligible to participate in the plan. Does this long-term part-time provision have to apply to those excluded employees? And that's unclear as of now. Further, if a plan uses an equivalency method, for example, if you don't track hours for salaried employees, you can't necessarily say that a participant has worked 1,000 hours when you're not tracking hours. So plan documents allow for an equivalency method to determine how many hours an employee has worked. For example, if a participant has worked weekly, 1 week, then that person is deemed to be credited with 45 hours of service. So that's the equivalency method that exists in almost all plans as an option. It's not required. But how does that impact long-term part-time employees? Do you cut that in half? Do you cut that in a quarter? So that's information that if your plan uses the equivalency method, how that's going to apply to your long-term part-time employees. And then further, we discussed what happens when an employee goes from part-time status to full-time status, but there is no discussion about what happens when a full-time employee goes from full-time to part-time. So the question is, does that participant, once they maybe meet 3 years of less than 500 hours, does then that person get subject to the 500-hour requirements? So those are questions that are still looming that we're waiting for the IRS to cover. Another big topic of conversation is how these long-term part-time employees are going to impact your audit requirement. So from a Form 5500 purpose, from a Form 5500 status, if a plan sponsor has fewer than 100 employees, and there's that 120 rule, which I'm not going to get into, but if just as a general rule, if an employer has more than 100 participants on their Form 5500 count, they are subject to an independent audit and they have to file a long Form 5500. So this change to force long-term part-time employees into a plan could really impact plan sponsors to where they used to not be subject to the audit requirement. Now with the addition of these long-term part-time employees, now they're required to be audited. And that's obviously a very significant cost impact to plan sponsors. And the idea of Congress is not to discourage plan sponsors from having a retirement plan. So they are working on that. Specifically, the DOL has proposed changes to the Form 5500 period, just to state we should be basing an audit on the number of participants with an account balance, not the number of eligible participants. That is not set in stone yet, but that is a proposal that the Department of Labor has made effective for the 22 plan year. So we'll obviously be doing 2021 5500s all through next year. So the 2022 5500 won't be required to be filed until July for a calendar year, July 31st of 2023, extended to October 15th. So we have some time to deal with that, but just note that that's another question that's looming that hasn't been answered. Another area where this could be very impactful are owner-only plans. So an owner-only plan is not subject to Title I of ERISA. So it's not required. They have different Form 5500 requirements and different notice requirements for employees because there aren't any employees. So if some owner-only plans are now required to cover these long-term part-time employees, that's going to blow their owner-only status. And so that's another area of which we're waiting for some guidance on. And then further, it's just not clear on whether automatic enrollment is going to apply to these long-term part-time employees. The concern is these long-term part-time employees, although, I mean, the rule is that they have to work 500 hours within a 12-month period for 3 consecutive years. That doesn't really indicate a lot of turnover. So I don't think that they will necessarily state that automatic enrollment does not apply to these employees, but we'll just have to see how it shakes out. So that's all I'm going to discuss on the long-term part-time employee as the current provisions stand in the Secure Act. But as I mentioned earlier, the Secure Act 2.0 has some changes to the long-term part-time employee rules. So to discuss those, I'll start off with that right away. So the long-term part-time employee rules as they stand in the Secure Act, the current Secure Act, employees are not eligible unless they meet 500 hours in a 3 consecutive year period. Secure Act 2.0 feels that that's too long. So Secure Act 2.0 states that an employee is only required to work 500 hours in 2 consecutive 12-month periods and then would have to become eligible. So as you can do the math, then that would impact employees starting 1/1 of 2023 instead of 2024. So we've got a lot of, so hopefully we'll find out sooner rather than later if Secure Act 2.0 is passed, because we do need to start working on this provision. I'm sure record keepers, document providers, valuation providers, all of them are going to have to adjust their services in order to take advantage or to be able to count and administer these long-term part-time employees. Further, one thing that I really hope passes is this provision here. So Secure Act 2.0 clarifies that vesting service is disregarded prior to 1/1 of 20, or prior to any years prior to 2021 are disregarded for vesting purposes, similar to how the eligibility is currently written in Secure Act. A tangential provision that I mentioned earlier. So I mentioned earlier, if you decided to just get rid of the long-term part-time employee requirement and just make immediate eligibility or provide for immediate eligibility for employee contributions, but provide a year of service requirement for employer contributions, then you don't have to worry about the 500 hour for vesting purposes. But there's a negative consequence to doing this. And that is if your plan is top heavy and you allow for immediate entry for employee contributions, but require a year of service for employer contributions, your employees that are just eligible to defer and not eligible to receive employer contributions would still be required to receive a top heavy minimum if your plan was top heavy. So what Secure Act 2.0 is basically said, employers covering otherwise excludable employees. That means anybody who hasn't met the maximum eligibility provisions of 1 year and 1,000 hours, those can be disregarded from the top heavy minimum. So this to me is a much appreciated provision in Secure Act 2.0 and would also, I think, encourage employers to just reduce their eligibility provisions for employees so that we don't even have to worry about this long-term part-time rule, and then you can disregard them from the top heavy. So I think this is a great provision that hopefully will pass. Another provision in the Secure Act 2.0 is the auto enroll mandate. And so what this is saying is that any new existing plans are grandfathered, existing plans prior to December 31st, 2022. These new plans post December 31st, 2022 would be required to have auto enroll, all plans, 401k and 403b. So the initial rate must be between 3 and 10%. If you go below 10% on the initial rate, then you have to have auto escalation of at least 1% per year up to a maximum of 10%. So for some of you guys that are familiar with the QACA provisions and, you know, it's just the ratcheting that can be administratively burdensome, some just jumped right up to the 6% of auto enroll so that they didn't have to deal with the ratcheting. Here, 10% is a pretty big deal. So if you wanted to avoid auto escalation, you would have to start participants off at 10% deferrals. This provision isn't going to apply to businesses in existence for less than 3 years and not to businesses with 10 or fewer employees. So as you can see, that's a very small population of employers that this would impact, that it wouldn't impact. So as I mentioned earlier, especially with the long-term part-time employee provision, Congress has just recognized that employees are not retirement ready, and they have determined that having a payroll deduction in a retirement plan helps participants to be better ready, and those participants tend to save more for retirement. So other provisions that I found to be noteworthy, as you guys already know with Secure Act, we increased the RMD age from 70.5 to 72. This Secure Act 2.0 is going to increase that even more. So effective 2022, the age would increase to 73. Starting in 2029, the age would be 74, and then starting in year 2032, the age would be 75. So it's ratcheting it up, understanding that people are working longer. Another item is the increased contribution, catch-up contribution, and this is very specific. It's only for employees between ages 62 and 64 are able to increase their contribution, their catch-up contribution to 10,000. And I say as index because, as you know, with any 401k, the deferral limit, the catch-up limit, the 415 limit, those ratchet up each year. So this 10,000 would be expected to increase as well. Another great provision that Abbott Labs came out with back in 2018 is the student loan provision. And so the way Abbott Labs, and for those of you unfamiliar, which I doubt that, but Abbott Labs back in 2018 requested a private letter ruling from the IRS to state, we would like to treat employees' contributions or payments to their student loan debt as employee contributions. And if they contribute or pay down their student loans, then we would like to benefit them in a form of it. In this case, it was a non-elective contribution to the plan of 5%, because that's what they typically matched in the Abbott Labs plan. They stated, if you put 2% into the plan, we're going to match you 5%. So Abbott Labs proposed to the IRS, we would like to, if a participant funds 2% towards their student loan debt, we're going to give them a non-elective contribution of 5%, similar to how we would match a participant contributing to the 401k plan. So the Secure Act 2.0 is putting that in writing. So it's stating that an employer may match, and not a non-elective contribution, they may match dollar for dollar or whatever the formula is within the plan. If an employee puts a contribution towards or a payment towards their student loan debt, a plan sponsor can consider that an employee deferral and match that, similar to how they would a participant in a plan. And this can apply to 401k, 403b, pardon me, 457b and simple IRA. So it is expansive. This would be effective for plan years starting on or after 1/1 of 2023. Pardon me, I think that's 2022, pardon me. For some of you that may have attended Carolyn Cumby's session earlier this week on the small employer tax credit, Secure Act 2.0, and she probably explained some of this, it's going to expand that tax credit. It's going to increase the credit from 50% to 100% of startup costs. It does reduce the small plan qualification from a plan sponsor with 100 eligible employees to 50. So it's going to reduce the number of plan sponsors that can be covered under this. But then it'll also increase the credit from a 3-year period to a 5-year period. So it'll expand it for 2 additional years. 2 more rules, and then we can go to questions. So, or 2 more provisions. So another one that's, I mentioned auto enroll earlier, that's going to be a mandate for any new employers. And so as some of you may experience, auto enroll is one of the most difficult provisions in a qualified plan to administer, and there's errors all the time. And so the IRS recognizes that. And so they've made it a little more, the corrections for plans that contain auto enroll, the corrections aren't as onerous on a plan sponsor. And so they're going to further expand the correction requirements for plans that have auto enroll to basically what they're just saying is, so long as you correct a plan within 9.5 months following the end of the plan year in which a failure occurs, so long as you, the correction is favorable towards the participant and you're not discriminating against others that are similarly situated, you're not required. So I think what the idea would be that you're not necessarily going to have to fund the employee, the missed deferral opportunity issue. You're not going to have to fund that, but you would definitely have to fund any employer match contribution that would be associated with the missed deferral. So again, these are all just in the works right now. Nothing is set in stone, but these are some of the provisions in the Secure Act 2.0. And then the last one, I think some of you guys that you run across a control group because you either have a minor child or you're in a community property state where you're required to, you're deemed to own the business of your spouse. So for example, I'm going to use lawyers. So let's say a husband and wife or 2 spouses are married and each of them has a law firm in which each of them own 100%. One of them has employees, the other one doesn't matter. But from a control group standpoint in qualified plans, if that couple has a minor child, then they are deemed to own each other's business, whether or not they work for that business, own anything outright in that business. They are deemed to own that business and be a part of a control group with their spouse's business because of the family attribution rules. Another one is in community property states. If you live in a community property state and your spouse owns 100% of a business and you own you own a different business 100%, you're deemed to own each other's businesses. So you're required to be within a control group with each other. So those rules have been onerous. I've helped the sales team a lot on prospects and sales. And we come across this rule and people just are astounded that, no, I have nothing to do with my spouse's business, but yet I have to be a part of a control group with them because of this rule. This would be a much welcome rule to be just abandoned with Secure Act 2.0. So we'll just have to see what happens with that. So with that, there's definitely other provisions in the Secure Act 2.0 that do impact qualified plans, but I thought those were the highlights of the provisions that I wanted you to know about. So with that, I'm going to turn it over to questions. So I'm going to look to see if there are any questions that exist out there. Let me stop sharing my screen so that I can see them.
I don't see any questions being submitted, Brooke.
Okay.
I guess if there's no questions, then we can go ahead and move on to the next portion of the 401k class. Appreciate your time, Brooke, and all the great information that you provided everybody.
Sure.
Okay, well, we're going to move next into what we call our study hall here to end things today. In addition to myself, we got much of the management staff on the call here with us. And we're just going to kind of do a roundtable. We've received various questions throughout the week from a lot of the plan sponsors that may be on the call today or other ones regarding a whole bunch of different topics, kind of random all over the place, just regarding the operation of their 401k plan and some of the provisions that dictate the rules and regulations of the plan. So we thought we'd just kind of go over some of those questions, just kind of answer some of those for you and hopefully give you some additional information on the operation of your plan and why we have to do some of the things that we do. So we'll just do a quick introduction of the various managers that are on the call here with us, and then we'll go ahead and jump in. So the first person I see in my view is Kim. So go ahead.
Hi, I'm Kim Patty. If you attended the 401k class on Monday, I did the presentation on eligibility and entry. I have 25 years of experience working on retirement plans, both on the DB side and the DC side. And the past almost 20 years have been at Brewster & Brewster, and which is now Definiti.
Thanks, Kim. Haley? You're on mute, Haley.
Hi, I'm Haley Erickson. I have been with Definiti for almost 2 years. I have 12 years of experience in the retirement plan industry.
Thanks, Haley. Leah?
Hi, my name is Leah Johnson. If you attended the 401k class Wednesday, I moderated the actuary cash balance session. And then yesterday presented on cash balance plans. So I managed the cash balance defined benefit, small plan defined benefit side of the business for Definiti. I've been in the industry for just about 20 years. 15 very specific to defined benefit and cash balance plans. So welcome.
Thanks, Leah. Melanie?
Hi, I'm Melanie Williamson. I have been in the industry for 30 years and with Definiti 16 years, or registered before that. I manage a group of defined contribution retirement plan coordinators, and I also head up our 316 services group. So you probably heard me speaking on Tuesday regarding our 316 services.
And I think we have a couple of 316 questions to go over today, which we'll hit on here in a little bit. So thanks, Melanie. Chris?
Hi, I'm Christopher Wilson. I've been with Definiti since April 5th of this year. This is my third national firm I've worked for. I'm a manager of defined contribution plans.
Thanks, Chris. And last but not least, Tim Maher.
Hey, good morning, good afternoon, everyone. Tim Maher. I am based in Tacoma, Washington. I've been in the industry since 1999, and I have the privilege of working with 16 retirement plan consultants on my team to help that your plans stay in compliance. So thank you for attending our session.
Thanks, Tim. And like I said, everybody here that's on the call with us today is part of the management team. There's a couple of managers that aren't with us, but this primarily does make up a lot of the leadership team here at Definiti. So we look forward to going through some of these topics with you. And so without further ado, I guess we'll just jump into some of the questions. So the first question that we received was, can you go over the new IRS limits that were recently announced for 2022? And Kim, I think you're going to address that one for us.
Yes, absolutely. So I'm going to start with the 401k, 403b salary deferral limits. So for 2021, the limit was 19.5 if you weren't 50 by the end of the calendar year. For 2022, that amount's going to increase to 20,500. So in the current year, which we are still currently in 2021, it's still 19.5, but next year it will be 20,500. And those are calendar year limits, even if you have a plan that is off calendar. As far as catch-up contributions go, for those who will be 50 before the end of the year, that limit hasn't changed from 2021 to 2022. So that will still be 6,500. So our totals for 2021, if you're under 50, it's going to be 26,000 still. But if you're in 2022, that increases up to 27,000. Next, I'm going to go into some compensation items. First being that retirement plans have a limit on the amount of compensation that you can take into account when administering the plan. For 2021, the maximum compensation limit was 290,000. That increases up to 305,000 for 2022. So that's the most that you can take into account for your plan in 2022. Also, the highly compensated employee limit, if you made over 130,000 in 2021, then in 2022, you would be considered a highly compensated employee. And that limit increased to 135,000 in 2022, which would mean if you made over that amount in 2022, you would be an HCE in 2023. Similar item would be the top heavy key employee amount. So if you are an officer in 2021 who made over 185,000, you would be considered a key employee, and that number jumps up for 2022 to 200,000. Another limit is the 415 limit, and this is the amount that any one individual can put into the plan for the year, and it includes both your employee and employer contributions. So in 2021, that limit is 58,000, and for 2022, that jumps up to 61,000. So hopefully that covers the increases in the limits for 2022.
All right, thanks, Kim. And I think I saw we had a post. Those limits are posted on our website, so you can go ahead and go out and download those to have them as well. I know they're sometimes hard to remember, but go ahead and download them. All right, next question. So one of our plan sponsors says, I'm a small employer and I'm responsible for all aspects of the 401k plan in addition to running my business. Is Definiti able to assist with my payroll submission or other aspects of the plan to reduce some of this burden? Melanie, do you want to take that one?
I will. Yes, Definiti can assist you with that payroll burden. We have a separate service agreement. So it's an addendum onto your third-party administration service agreement with Definiti. In order to do that, we would need access to both your payroll and your custodian so that we're able to access your payroll files on a payroll basis so that we can then upload them directly to your custodian for you. So it does eliminate you having to log in each pay period to make sure those deferrals are submitted timely to your custodian and for your participants.
Okay, and I think depending on the number of payrolls, the access that we would have available to us, the cost could vary depending on some different factors. So if it is something that you'd be interested in looking into a little bit further, reach out to your retirement plan consultant, and we can see if that's something that's feasible for you and kind of work from there. Okay. Next question. We have a lot of terminated participants with balances in our plan. Can Definiti help us locate and force out those accounts? Haley, that one's yours.
Yes. So this question has kind of two parts. One, if there are terminated participants that maybe are considered lost. So they would be considered lost if they terminate employment and they're leaving either a partially or a fully vested account balance in the plan, and then they fail to update their address or keep their address current with either you as the plan sponsor or with the custodian. And so these obviously can be a little bit of a frustration. There are costs involved with keeping that money into the plan. We're happy to offer a service that we can do a participant search through our partner with PenChecks. So once we complete your annual evaluation, your RPC retirement plan consultant should be able to help you identify those participants, and then we can help you with the search. The second portion is regarding the force out process. So if most plans have a provision that participants with account balances of under 5,000 can be rolled over into an IRA. And then we can also help you with that as well through PenChecks.
All right, thanks, Haley. And I'll just elaborate a little bit on that. So we do have a partnership with a company called PenChecks. They are a national provider that focuses on distribution processing. For those of you out there that maybe aren't on a record keeping platform like a John Hancock or a Voya or a Principal, we use PenChecks to facilitate those distributions out of self-directed brokerage accounts or pooled plans. If any of you have those, they specialize in that. So then they handle all of the tax reporting, 1099s, all the remitting of payroll taxes. They streamline that process very effectively. But they also have services where we can force and use them to set up IRAs as well. Now, some of the record keeping platforms like a John Hancock, some of them have their own solutions, which we can certainly use, and we'll work with you on identifying the best solution. But in the event that your record keeper doesn't have that solution, PenChecks is another option that we use. You know, like I said, are very effective in what they do, and we have a very good partnership with them. So if you want more information about that as well, certainly reach out to your RPC and we can get you some more details. Okay, next one's a good one. It seems like there are so many notices we need to provide to our participants. Can you explain the various notices and when they need to be delivered? Chris, you want to take that one?
Sure, I'll take that one. Yeah, there are a lot of notices that need to be delivered. You as the plan sponsor can deliver the notices. You can do it in a couple of different ways. You can physically hand the notices to the participants. You can mail the notices to their last known address. You can provide it to them, let's say, with a paycheck if you're still issuing, paper paychecks. Okay. Another option you have is you can deliver it electronically. We have the electronic delivery regulations that we can provide you, and there's certain steps you need to take in order to be able to deliver the notices electronically to your participants. Okay. The other route you can go is if your plan has its assets on a platform, such as Hancock, Transamerica, American Funds. Those record keepers oftentimes have notice delivery solutions that we can use. Okay, so that is another avenue you can take. The last avenue is through us, through Definiti, through our fiduciary or 316 services. We can provide the notice delivery service to you. So the delivery service you decide upon is based on the facts and circumstances of where you're at. If you're a small employer with only a few participants, you're probably going to deliver it yourself, either physically or through electronic means. If you're a larger plan, then perhaps partnering with your vendor would be a good solution. If you don't want to take any of the responsibility and you don't mind paying for that service to be provided by us, then that's a service that you would engage through our 316 fiduciary services. So you have to talk to your retirement plan consultant here to determine what solution is a best fit for you. And there can be a mix of solutions, okay? Perhaps you want to provide one notice electronically to your participants, and perhaps the other notices you want delivered by the vendor or by us, okay? So it's not all or none. You can mix and match depending upon your circumstances. The notices that need to be delivered are annual notices, okay? They're delivered to current participants as well as new participants in the plan, okay? So every year you must provide your participants with or without an account balance, what's called a summary annual report. And it's literally, it summarizes the annual report that we submit to the Department of Labor, okay? If you have a safe harbor plan, you need to provide a notice to your participants at least 30 days before the beginning of the plan year to notify them whether or not your plan is going to operate as a safe harbor plan. Same if you have an automatic enrollment plan, you must provide that notice before the beginning of the plan year. Okay. For those plans that utilize brokerage accounts, there's a brokerage account election form that you must provide your participants so they can decide whether they want to invest their assets, their monies with a brokerage firm, or whether they want to invest them, let's say, through another platform, such as a John Hancock or a Transamerica. Okay. Once someone becomes enrolled, there's a salary deferral election form. They have to elect whether or not they want to contribute to the plan, and if so, how much. Along with that comes a beneficiary designation form. In the eventuality, in the unfortunate eventuality that they should pass away, we need to know who their beneficiaries are so their account balance can be distributed to them. For those plans whose assets are with vendors, you have what's called a 404A5 disclosure notice. That discloses the fees to the participants that are being deducted from their accounts. Okay, so those are the major notices that need to be delivered. And depending upon, again, the size of your plan and the facts and circumstances, how they're to be delivered, we can custom tailor that for you.
So Chris, do the notices, I think you touched on it, but can you define what the eligible employees are, that who would get those notices generally?
Yeah, okay, so the summary annual report, again, it's after the preparation of 5,500, that goes to all active participants. So you have participants that have an account balance that are still employed by you, they need it. You also have former employees who have an account balance, they also need that notice, okay? New participants to the plan, employees who have satisfied the plan's eligibility requirements, have come into the plan, they need to be provided all of the notice. They need to be provided the automatic enrollment notice if you have that feature in your plan, the safe harbor notice if you have that option, a brokerage account election form, the summary plan description, which describes the benefits, rights, and features of the plan, so they understand how the plan works, okay? Continuing participants also need to be provided the safe harbor notice before the beginning of each year, along with the automatic enrollment form. Did I cover that, Matt, for you?
I think so. So I think essentially anybody that's eligible for the plan, regardless of whether they have an account balance or not, and then any obviously active participant that has a balance and a terminated participant that may still have a balance as well,
right,
would also be required to receive these notices that we're talking about. A question came up, if a person doesn't qualify till 2022, then they're not required to get the notice, which would be correct. If they're not eligible for the plan yet, they're not required to receive the notice. And there was another comment, so this may be a silly question, but is there a list of these notices outlined in our plans? So there is a ton of different notices, like Chris had mentioned, between Definiti and also your record keeper. We'll let you know when those notices need to be provided to your participants. Some of those will come directly from us, like the safe harbor notice, the SAR that he mentioned. Typically that's going to be provided to you after the Form 5500 is completed, and then we'll give you that. It's usually a one-pager that needs to go out to the participants. So we'll provide you that information. Your record-keeping platform will provide you information generally on the 404A5 participant notice that needs to go out to all your participants. So I know sometimes if you're on a record-keeping platform, you get inundated with a lot of emails from them, on different topics. You do want to make sure you pay special attention to those emails. Some of them are important, some of them aren't, but they'll let you know when those notices are available and when to provide those to your participants.
Matt, I will add that, for the notices that we provide, for those of you who use our Gemini portal to provide us information securely, and then that's the portal to which we upload our reports, we can put the notices out there for you so that when the time comes, when employees become eligible to participate in the plan, you can go right to that one spot. There are all the notices that you need to provide to them. Okay.
And we get that it is confusing and there's a lot of different notices, and some apply to some plans and some don't apply to others. So I know we've said this a lot, but encourage you to just work closely with your retirement plan consultant.
Right.
They'll help you navigate through all these different notices and kind of the timelines of when you should receive them and things like that. Okay, moving on. What are the key dates and timelines I need to be aware of as the plan sponsor of a retirement plan? So Haley, we'll let you take that one.
Yeah, I'll just go through some key dates throughout the year to know about. Your RPC, of course, will help you navigate these dates as well. Starting with January 31st. So any 1099s to participants that took distributions in the prior year, those are due to be sent to participants by January 31st. Along with that, if you're required, you would need to file your Form 945. A lot of that, this part, the 1099s, is handled by our record-keeping partners. Another important deadline at the end of January is if your plan is subject to certain testing, it's good to kind of get us your year-end data by the end of January so that we can get that testing done for you. So that testing, which I'm referring to, is the ADP test. Deadline for any corrections is March 15th. So that's why we ask for the data by January. July 31st then is the next kind of important date for your retirement plan. That is when your annual Form 5500 is due. We can also put that on extension. That the extension also has to go out by July 31st. The extension will extend the deadline to October 15th. So that is the final deadline of your Form 5500 for the plan, if it is a calendar year plan, of course. September 15th, I kind of skipped over that one. That one's an important funding date for our cash balance or defined benefit plans. It's also the employer tax return if you've put your tax return on an extension as well. And then December 1st, Chris noted that some certain notices have to go out by December 1st. So those are also, that's also an important date to keep aware of. And then by the end of the year, your required minimum distributions are also due.
Okay, thanks, Haley. Next topic. Please explain the roles of Definiti, my record keeper, and myself as plan sponsor in the processing of distributions and loans. So this is a very common question we get regarding loan and distributions. And Tim, you're going to tackle that one for us.
Yeah, thanks, Matt. And good morning again, good afternoon. And I just want to say thank you for attending and also, allowing us the privilege to work with you on your retirement plan. So loans and distributions can be, they can be confusing. They can be an area that, you might need some assistance. Your retirement plan consultant is someone that can always help you in those situations. So what I'd like to just kind of go over is, the roles and responsibilities of each party. So when it comes to distributions, one of the many services that we provide as your third-party administrator is the ability to process the loans and distributions for the plan participants. At Definiti, we have a dedicated team of retirement plan associates who support your Definiti consultant. And those associates are there to ensure that each request is in good order and to process those loans and distributions. So let's focus on distributions first. Most plan sponsors today are using a platform, and those platforms have the ability for the participants to log in online, and they can request a distribution from their own account. We will then get a notification, the retirement plan team will get a notification via email of that request, and then they will make sure that it is in what we call in good order. And what that means is we will make sure that the request is allowed per the plan document. We'll also look at updating vesting at the platform, and also check to ensure that the participant is not required to take their first required minimum distribution before they're paid out of their account. And the last step is that we will then approve that distribution online. Generally, what happens after that is the person who's designated as an authorized representative or signer at the plan sponsor level, they will be notified of the distribution request, generally through an email, and then they will log in to approve or sometimes deny the distribution, depending on if they have information that Definiti doesn't have at the time. So that's what we do with distributions. Regarding participant loans, so if your plan allows for loans, it is a similar process that is followed, just like the distributions. The difference between a loan and a distribution is that a distribution has taxation when it is distributed, versus a loan is not taxable at the time the loan is processed. Our RPA team, they will ensure that the amount that is requested based on the amount that is requested is permitted based on the loan policy. They will also take vesting into consideration for the calculation, and then the loan is submitted for approval by the plan's authorized representative or signer. Depending on the platform, generally the authorized signer will receive an email notification that the amortization schedule and other loan documents are available for downloading. It's very important to make sure that the amortization schedule is provided to the person designated in your organization to do payroll, to make sure that the loan payments can be deducted and then transmitted timely to the platform. If you don't have a retirement plan that is at a platform and it is a self-directed account or a trustee pooled account, we do kind of handle those distributions similar to the platform. It's primarily started by your retirement plan consultant, and once we know, if you're requesting a loan or distribution, that information is sent to our RPA team. We'll follow the same in good order process, and we will help ensure that the distribution or loan gets distributed from the non-platform account. Thank you.
Thanks, Tim. And I'll just add, so historically, these have all, most of the loans and distributions, you're probably accustomed to doing a lot of paper forms. You'll see a lot of our record keeping platform partners, as well as ourselves, are starting to push online loans and distributions a lot more. For those of you that may have been on some of the earlier sessions this week about cybersecurity, obviously that's a huge concern for everybody in the industry, and something that we take very seriously, and kind of promoting online loans and distributions will help a lot in kind of defending that. So if you're not sure if your record keeping platform where your plan's at has online loans and distributions and you haven't been using them, or you want to see if they have them available, reach out to us and we can certainly look into that and help you promote that going forward. Okay. So with us getting close to year end here, we'll be starting to get ready to prepare your compliance testing. So we have a question regarding that. So what information do I need to provide at year end in order for Definiti to complete my compliance testing? So Haley, what are the main things that we need to receive?
Yeah, so to get us started, at the end of the year, so at the end of December or very beginning of January, you'll get a communication from us regarding the requested items that will need to start your annual administration. So those two main items, there's a census file, which is an Excel template, and then the annual questionnaire. So the template includes your employee data, so any demographic data, including compensation, any excluded compensation from the plan, the contribution amounts, so deferral, Roth, if you've made any matching or other employer contributions during the year, those are all going to be requested on that census template. And then the annual questionnaire, which is a questionnaire, it includes data that probably didn't change from last year, but could change from year to year, which is why we ask for confirmation on this information each year. It includes information such as your fidelity bond, your ownership, any changes in ownership, any family relationship changes, contribution intentions, lots of different questions on there that help us when we are going to do your annual administration.
All right, thanks, Haley.
Hey, Matt, if you don't mind, I wanted to piggyback on Haley's comment for a second.
Sure, jump in.
Sometimes we find that the questionnaire is the last piece of information we get, because to sit down and go through it, some clients think it's a hassle. But the questions we're asking you are essential to keeping your plan compliant with federal law. Okay. And the one I run across the most is clients who don't disclose the owners, the ownership, the officer, and any family members, as well as family members who own other businesses. Okay. Oftentimes clients will tell me, well, you know, my spouse owns a business. It has nothing to do with my business. The two are completely unrelated. And I understand the client's perspective on that, but under federal law, there are rules which we call aggregation, where a spouse's ownership in one company is considered to be owned by their spouse. Okay, it's called attribution. So if your spouse or your children or your parents have ownership in other companies, it's essential that you tell us that, so that we can determine, you know, how to proceed accordingly.
And I think Brooke mentioned a little bit about that there are some proposed changes to that, which would certainly be welcome. So we'll have to kind of see where that goes. But yeah, getting that information for us is critical so that we can ensure your plan stays compliant. Kind of switching gears a little bit, but I think this is also something Brooke talked a little bit about some proposed changes. Here over the last couple of years, there's been numerous updates to the required minimum distribution rules. Last year for defined contribution plans, at least, those rules were waived, and now some of the The ages have changed here recently. So Melanie, can you kind of give an update on what it means to need a required minimum distribution for their employees?
I definitely can. So you're right, the dates have changed. It looks like they're going to be, or the ages have changed. And it looks like going forward, the ages are going to change again on us. So prior to 12/31/19, you were required to take a minimum distribution from the plan if you were an owner with greater than 5% ownership, either directly or indirectly, regardless of employment status, or if you were a terminated employee who was age 70 and a half prior to 12/31/19. The new rules that came out in 2020 changed that 70 and a half to 72. So now you must obtain 72 after 12/31/19 if you're an owner, and a terminated employee would be the same thing after 12/31/19. Now, to complicate things throughout all this, when they made the change, they also waived the first year. So now you've got people who didn't have their first year RMD because it was waived, and now we're moving them all into 2021. So basically what you just need the basic ages to watch out for is if you were 70 and a half before 12/31/19, you continue on with getting your RMD. And then when you turn 72 after 12/31/19, that's when you'll start taking your RMD again. Your retirement plan coordinator or consultant is there to help you. If we have those dates on our census for your people and they had met that age, we are monitoring that, and we'll shoot you a quick email saying, these people we believe are eligible. If you hire somebody new and they happen to be over 70 and you haven't turned a census into us yet, you might want to let us know, because obviously we're not going to know about them. And that's probably a good thing to make sure you look at your dates of birth to make sure we're getting accurate information so we can assist you with this process.
But if there's an active employee, Melanie, that is not an owner, they're not required to take an RMD, correct?
That's correct.
Okay. Thank you. Okay, next topic. Many of you probably have received notification from us regarding this document restatement period that we're in, and that always brings up a lot of questions. And that's what this particular question's are about. It says, we started our retirement plan in 2019, and Definiti is telling me I need to restate my document. Is that true, and why? Kim, can you answer that one?
I can, and the answer is yes. You do need to restate during this period of time, and let me explain a little bit about how it works. So every 6 years, you get 2 years to restate your plan onto an updated pre-approved plan document. So for 401k plans, we're in the middle of that 2-year cycle right now. It started August 1st, 2020 and closes on July 31st, 2022. And you must restate your plan onto what we're calling the cycle 3 plan document during this time. So this is mandatory according to the IRS and DOL, and it's necessary to keep your plan in compliance and up to date with current legislation. So that document that was done a few years ago, it would have been for the last mandatory restatement, which we call the PPA document. And that really only considered law changes through 2010. So since then, there have been several changes that impact retirement plans, and these are going to be in your cycle 3 restatement. There's the ability for plan forfeitures to offset certain contributions. You can amend a safe harbor 401k plan once the year has already started now. The creation of in-plan Roth transfers. So even if you just had a document not that long ago, these changes weren't included in that document, and they will be in this new cycle 3 that needs to be done by the end of July next year. I also wanted to point out, and Brooke brought this up a little bit earlier, about amendments that need to be done as well. So we've had some questions about the CARES Act amendment. It's actually due on 12/31/22, and we do anticipate being able to send it out to clients probably early on in 2022, as soon as it's released by our document vendor.
All right, and I'll just add, don't blame us, blame the IRS. They love to make life difficult for everybody, and I know it maybe doesn't seem fair that we have to do all these document restatements, but those are the rules and regulations that we're given, and that's just what we're following. And I'll just add too, like Kim said, you know, a lot of the things that go into this current document restatement that was already in motion before, you know, everything came up with COVID and the CARES Act and the Secure Act. So you are going to see, even before we hit this next 6-year cycle, 6 years from now, various required amendments that the IRS is going to make you tack on to your current document that you have. And we'll certainly keep you in the loop with all of that and make sure that your documents are amended timely. But it is quite the exercise that I know it doesn't feel like it should be necessary, but we can always blame the IRS. Okay, for those of you that may not have been on our 316 presentation earlier, we had a quick question about that. So what does it mean to have a 316 fiduciary? And if I have one, am I still considered a fiduciary on the plan? So Melanie, as our director of 316, you can go ahead and answer that.
I definitely can. So yes, you are. We share the responsibility. 316 fiduciary and the plan sponsors share the administrative fiduciary responsibilities on the plan. One of the things that we talked about earlier was the notices, and you know, how do you as a plan sponsor know what notices, when they have to go, how to get them out, what to do with them all? That's what we do from an administrative 316 fiduciary services for you. We are that list behind the scenes that says, all right, it's time to do this, and we work with you as the plan sponsor to make sure it all gets done. Some of the other things that we do is we help you make sure you enroll your participants timely, because we do the eligibility for you, and then we make sure you get all the forms you need to be able to enroll those participants. All the things that Chris mentioned, we will put that together for you as your 316 fiduciary. So basically, we partner with you on the administrative side to make sure that all the things that need to be done on a plan are done and done timely.
Okay. The next question is also one that we get very frequently as we're, administering plans. It's about rehired employees. And I know these are always confusing to our plan sponsors. So what about rehired employees that were eligible and participating? When can they contribute again? So Tim, can you explain a little bit about rehired employees?
Yeah, thank you, Matt. So, you know, we all lose a good employee, you know, once in a while, and then sometimes they come back to us and they're like, you know, the grass definitely was not greener over there. And, you know, if they've already satisfied eligibility and they've been a participant in the plan, generally when they're rehired, they are eligible upon their date of rehire. One thing that I like to do when I get calls from plan sponsors is to you know, show them where are the answers. And a lot of the answers are found in your adoption agreement, but more specifically regarding, you know, rehired employees, if you look at page 5 or sometimes page 6, under the minimum age and service requirements, there is a paragraph that begins with eligibility upon rehire. And it will generally give you the answer right there in terms of if the employee that you just rehired can rejoin the plan upon their reemployment date. One thing that I also like to stress with plan sponsors when they call is even though you rehired that employee, go ahead and treat them as a new employee when it comes to making sure that they get all of the required forms and notices. So, you know, Chris had mentioned all the required notices on one of the questions that he answered. But again, making sure that they get their deferral election form is important. Make sure that they get the beneficiary form, because during their lapse of employment with you, they may have gotten a divorce. So their old beneficiary form may not apply anymore. So they should also get a copy of the summary plan description, any of the required notices that, especially like a safe harbor notice if your plan is safe harbor. And the last thing that I always stress to plan sponsors is make sure you give the participant the ability to connect with your retirement plan financial advisor so that they can seek out, investment guidance. But if you, if you get to that point, I know that a lot of us are busy during our day. If you can't locate your summary plan description, please call your retirement plan consultant and they will be able to walk you through on what you need to do to ensure that they're either eligible or not eligible.
Hey.
Matt, you're on mute.
Matt's on mute. Hey, this is Chris. I'm sorry, Matt. One second. One thing I wanted to add to Tim's comment. He just jogged my memory about beneficiary designation form. Okay, and this question has come up throughout my career. If you don't change your beneficiary designation form, and let's say you divorce, but you change everything else, or let's say you have your estate documents that name beneficiaries that are different than the beneficiary form that you filled out for the plan. You have to understand that the beneficiary form for the plan is the governing document. The courts look to that document to see who the beneficiaries are for that plan benefit. So make sure if there's a change in your life circumstances that you update your beneficiary designations at all of your financial institutions and retirement accounts.
Thanks, Chris. Next question regarding eligible employees. Is it Definiti's responsibility to notify us of eligible employees? Chris, I know you were just talking, but can you answer that one?
Unmute. I'm sorry, repeat the question for me, Matt.
Is it Definiti's responsibility to notify us of eligible employees?
No, that is our responsibility. The whole purpose of hiring a third-party administrator is because we perform the function without any, we're impartial. That's the whole point. You provide us a census, and to piggyback on what Haley said about the year-end employee census request, and I've seen this from time to time, we need from you an employee census, not just a census from who you think participants are in the plan. That's our job, is to determine eligibility. You give us a complete employee census, and based on the plan provisions, we will determine who is eligible for your plan.
For testing purposes, I guess I would just clarify that ongoing, as you have newly eligible employees, it's the employer's responsibility to make sure that you're enrolling and calculating when your employees become eligible. Now, kind of going back to what Melanie was talking about earlier with our 316 services, if that's something that you need assistance with, 316 does offer calculation of, looking at your payroll on an ongoing basis throughout the year and giving you the list of the people that are eligible. Otherwise, you got to understand your eligibility requirements for your plan and look at those entry dates on when people can become eligible, and make sure you're looking at those employees that might have met the requirements and give them all of the enrollment materials in order to become and start contributing to the plan if they would like to.
Yeah, thank you for clarifying that, Matt. Let me revise my comments. We get a census once a year, and it is after the year is over, and then we take all the census data and we determine who became eligible for that year. Okay, but as Matt said, you need to make sure that as employees become eligible during the year, that you are providing them the required disclosures, and then you're getting them enrolled, especially for a 401k plan. You're making sure that they get their salary deferral agreement to you in place so that they can start their salary deferrals upon their entry date into the plan.
Great. All right, so the people that you've heard from mostly today are on our defined contribution side. Leah has been pretty quiet because she heads up our cash balance side of the business. So we do have a couple of questions for you, Leah, that you can help us answer for our cash balance people that are out there. So one question is regarding overfunding. So what does it mean if my cash balance is overfunded?
Sure, that's actually a great question. So in a defined benefit plan or cash balance plan, every year you're given a minimum, a maximum, and a recommended contribution. When you fund, a lot of the times it's okay to be overfunded. When you fund towards the maximum, what you're doing is overfunding your plan, which may not be a bad thing, depending on the circumstances. And so, for example, maybe for the plan, the intent is to fund the absolute maximum for the first year or two. And then the contributions will kind of back off, which is perfectly okay. The only issue with the plan being overfunded is at termination. What that means is that the plan is more funded than what you've actually actuarially accrued in the plan. So, for example, the actuary each year will calculate what the actuarial value of a participant's benefit, the owner or participants is. So let's say that value is $200,000, but maybe the actual investment assets have $300,000, the actual investment account. So in that sense, that plan is overfunded because there's more assets or more funds in the plan than what is actuarially accrued. So it's a complex calculation. Having an overfunded plan doesn't always, mean, something negative. It's just something to look at for as you move towards maybe terminating the plan or as you near retirement and things like that. And that's something that the actuary and the analysts are evaluating every year, and we'll give you a heads up.
Okay. And continuing with our cash balance questions. If I send you my 401k information, can you tell me if a cash balance plan would work for me or my company?
Absolutely. My team, the cash balance team, does a lot of proposals. Depending on the demographics of your particular business, a cash balance plan may or may not be advantageous. But with the data, the census data, the information on your 401k, the employee data, ages, salary, all of that sort of thing plays into the defined benefit calculation. But that's exactly what we would need to be able to tell you whether or not a cash balance plan, or show you some options for a cash balance plan and whether that will work for you. So if that's something that anyone, any sponsor here may have a question about, or maybe you're not sure what a cash balance might look like, please contact your RPC and they'll contact our team, and we'll be happy to run proposals to show you some illustrations of cash balance plans and how that would look for your particular company.
Great. And we have one last cash balance question here. So regarding distributions from a cash balance plan, when can employees take their money out of a cash balance plan?
So a little bit different than in a profit sharing or a 401k plan. A cash balance plan does not allow for distributions while a participant is still employed unless they've reached normal retirement age or, of course, death or disability. Comparing to a 401k plan, you could have a participant take, depending on the plan, a financial hardship or in-service distribution. A cash balance plan does not allow for that until to the normal retirement age, or when that participant terminates employment. Otherwise, those funds do stay into the cash balance plan. There's not loans allowed on the cash balance plan, financial hardship, that sort of thing. That is only allowable at retirement age or, of course, termination of employment. It's a great question.
All right, well, that actually was all the questions that we had, and it looks like we're right at our time. So that all worked out perfectly. So again, I want to thank everybody for being with us today and all week. We hope this is now our 30th year that this has been going on, and hope that everybody found it useful. I know we want to continue to offer this to all of our plan sponsors and advisors to continue to educate them. We're continuing to look for additional ways that we can provide you resources to help you administer your plan and understand the ins and outs of your retirement plan. We've had plan sponsor guides that we've created. We're going to continue here as we get into the new year. You'll see some additional things from us to help in these different aspects. So stay tuned and watch for those types of things. But again, appreciate your time, appreciate your business and trusting us with your retirement plans. And if there's anything that we can ever do to help, certainly reach out to us, and we're here for you. So thank you. Have a great day, everybody.